We all know interest rates have remained extremely low for the past 6 years, and this is one of the factors that is used to determine pricing of long-term care products. While this has been happening, nursing home costs have been soaring. It was estimated, and this is the most current number we have is at the end of 2013. The average one-year stay in a private room in a nursing home tipped over $90,000. And some part of the reason is people are living longer. And you know, the longer people live, the more likely they are going to need care at some point in their life. And as a result of this, we've seen some fairly dramatic premium increases in long-term care. And just as important, we've seen a tremendous amount of tightening in the underwriting department. And as a result of all these problems currently facing, we call it the America's long-term care crisis. A lot of the traditional long-term care insurers have exited the market. The unfortunate thing about that is, and just to kind of give you some numbers, if we go back to 2002, which was kind of the traditional long-term care heyday, the industry wrote $1.2 billion of premium spread over 104 companies. And if you fast forward 10 years to 2012, the premium volume dropped to $580 million. So that's from $1.2 billion down to $580 million, and that was spread over 24 companies. So as we've seen some of these companies exit the marketplace, it's unfortunate because we have 10,000 boomers hitting maturity every single day. And so the demand for long-term care products is likely to increase, but the supply has shrunk. So what is the solution? Maybe we just need to look at long-term care from a slightly different perspective. And we believe the combo product, AnnuiCare, may be the solution to some of America's long-term care crisis. Now, that graphic on the right is the AnnuiCare brochure. I wish I could just open that up right now and kind of walk you through it, but it's a 4-pager. It's very simple. It starts out, it goes through the concept and all the way through to the close. So it's just like a 4-page sales presentation. Now, getting into the nuts and bolts, AnnuiCare comes in 2 chassis, AnnuiCare 10, which is issued through age 79. The current interest rate is there on the right. That's 3%. And I think you'll agree in today's low interest rate environment, 3% is a pretty good rate. And then for your older clients, we have AnnuiCare 7, issued all the way through age 85, a little bit less interest because a little shorter chassis. It's 2.75%. And I'd like to also point out that these interest rates you're looking at, they're not locked in. The Guaranty Income uses what's called a portfolio renewal style, which means as interest rates in general trend up, your clients' renewal rates will trend up as well. And conversely, if interest rates were to go any lower, I don't know if they can, but if they were to go lower, then their renewal rates would trend down. So we believe we've built up products by using this type of renewal rate that's going to have a competitive rate no matter what the interest rate environment is. Now, AnnuiCare, I want to point out, I know you've seen some other companies that are offering asset-based long-term care, but AnnuiCare is the original annuity LTC-based long-term care, and it's offered exclusively by Guaranty Income Life, and it's specifically geared toward both annuity and long-term care producers. And I think it's worth reiterating because experience says a lot. This is the very first annuity LTC combo product introduced in America. Now, that may pose the question, why did Guaranty Income back in 1999 decide to develop an annuity that also had long-term care benefits? Well, it's because we studied the demographic, and what we learned is that 85% of Americans age 65 and older do not have any form of long-term care insurance. Matter of fact, if you dig down a little deeper and you get down into the earlier 60s, you'll see that 90% of Americans don't have long-term care insurance. So what that means is that 9 out of 10 of your clients or 9 out of 10 of your prospects do not have long-term care. So it's a great way to get a conversation started. But first, let's take a look at some of the reasons why 9 out of 10 people have chosen not to buy traditional long-term care. Number one, we know there's been a lot of premium increases. It's become expensive. And I think for some people it's just cost prohibitive. And also we've seen a tremendous tightening in underwriting, and it's become rigorous and lengthy. And, 10 years ago, somebody who, a 60-year-old 10 years ago who may have easily qualified for long-term care, that same 60-year-old today may find it more difficult because, again, underwriting's become more stringent. And those are all good reasons. But at Guaranty Income, we believe the number one reason why 9 out of 10 Americans don't buy long-term care is because they're just reluctant to pay for something that they might never use. So that's kind of developed into a consumer mentality, and I think that mentality is it's a use it or lose it proposition. In other words, if I don't use my benefits, well, I've lost my premium. Well, premiums being as high as they are today, some people are paying $4,000 and $5,000 a year. My gosh, if you pay $5,000 a year for 10 years, that's without any increases, that's $50,000. And if you pass away without using benefits, the money's gone. So AnnuiCare was really designed to solve that problem, and it does solve that consumer mentality problem. And I'm going to get to that in just a moment. But first I want to point out the end result is this. The majority of Americans, 9 out of 10, are self-insuring for their long-term care needs. And you know, folks, at a cost of as high as $90,000 a year, they are most certainly gambling with their own life savings. So what we decided in 1999 is, you know, you just can't fight 9 out of 10 people. If 90% of Americans decide, I'm going to self-insure, well, we decided, okay, we're going to help you do it and create a better way to self-insure, one where your money is going to be safe, free from market risk, liquid. It grows tax-deferred, but most importantly, it triples in value to cover long-term care needs. So, for example, if somebody deposits $100,000 into AnnuiCare, they will immediately have $300,000 to pay for their long-term care needs over a 6-year period, and all of the benefits are paid income tax-free. So why is it a better way to self-insure? Well, because $300,000 of benefits better than $100,000 sitting in a CD. Now, as we go through this this morning, again this afternoon for some of you, I'm going to throw in a couple of sales concepts, and these are field-tested concepts that some of our top AnnuiCare producers have used across the country. And here's the first one. You know, folks, sometimes asking questions is going to get more sales progress than providing information. So in sales concept number 1, we're really going to ask 4 questions. So it's Mr. and Mrs. Jones, what if I can show you a way to protect your assets from the high cost of care, and while doing so, you still maintain complete control of that asset? Now that asset, whatever you put in, you'll receive 3 times that back, three times that amount back to pay for your long-term care. So for example, again, if you deposit $100,000 into this type of an annuity, you'll have $300,000 for long-term care. Now, if you never do get ill or injured and you have no need for care, you can pass this entire asset on to your heirs plus net interest. So it's not really a use it or lose it proposition. It's going to get used one way or the other. And what if I could show you how to do all 4 of these things with no out-of-pocket premiums? You don't have to write a check. Would that interest you? So folks, that's a nice little setup, kind of describes AnnuiCare, and done in the form of a question. Sometimes can be more effective. Now I want to share a second sales concept with you. And as I'm going through this, you're going to be learning more and more about AnnuiCare. You know, let's talk about that person that's self-insured. You know, sometimes describing something they're not familiar with and comparing it to something they are familiar with is going to also get you sales progress. Now, everybody understands bank CDs. So imagine your prospect that has, let's say they have $600,000 or $700,000 in total savings, and they decided we're going to take $200,000 of this and put it aside someplace, hopefully safe, in the event that we incur long-term care expenses. That's going to be our go-to money. Now, which is not a bad idea. But now imagine the same person with that $200,000 in a big duffel bag, and they're standing on the street. Obviously, that's not safe. But their purpose of being there is they're going to put the money in the bank. Now, as they walk up to the bank, they notice there's 2 banks right next door to each other. There's a bank here on the left, and there's one over here on the right. Now, the bank on the left has a sign in the window that says, deposit your money here. It'll be safe. You'll get a fair rate of return. Should you get ill or injured and incur long-term care expenses, no worries. You can come down to the bank. You may have to pay a little interest penalty, but for the most part, you can withdraw your $200,000 to pay for your long-term care. So what did I just describe? Well, that's a typical bank CD or money market account, something they're familiar with. Now, they're looking at the sign in the window on bank number 2 over here on the right, and it's a similar sign but a little bit different. It says deposit your money here. It will be safe. You'll get a fair rate of return. However, should you become ill or injured and incur long-term care expenses, you can come down to this bank and not just withdraw the $200,000 that you deposited, but over a 6-year period, you can withdraw 3 times that much, in this case, $600,000 to pay your long-term care expenses. And folks, that will generate $100,000 tax-free per year for 6 years. So I guess the question would be this: if you were that person, self-insured, and you were looking at these 2 banks and you didn't have long-term care, which one would make the most sense to you? So, obviously the bank on the right. So again, this is a technique that's been used by some of our most successful AnnuiCare producers. Now, earlier when we were talking about some of the reasons why people don't buy, or 9 out of 10 people have failed to buy long-term care insurance, is that consumer mindset. If I don't use my benefits, I've lost my premium. And I promise you that AnnuiCare solves that problem. Here's how that works. If your clients don't need to use their long-term care benefit, they get their annuity deposit back plus net interest. Or if they were to pass away without using benefits, the entire annuity value plus net interest will be passed on to their heirs. Pardon me. So what did I accomplish? Or what did AnnuiCare accomplish? We've changed that consumer mindset from a use it or lose it proposition, where some people it's just not attractive, to this: it's a benefit if I need it, and my money back if I don't. So folks, AnnuiCare, we believe, solves the #1 reason or problem why the majority, 9 out of 10 people in America, have chosen not to buy long-term care insurance. So right now I'm going to go through the AnnuiCare concept, and this is something we could try to make it complicated if we wanted to, but AnnuiCare is such a simple product. We're going to take the simple approach. The simplicity begins right here. The numbers I'm about to show you apply to both male or female. So AnnuiCare is not gender distinct, meaning females really do have an advantage with this type of a product. So here's how AnnuiCare works. They deposit, in this case, let's say $200,000 into the AnnuiCare annuity. The AnnuiCare rider will immediately reserve an additional $400,000 of long-term care benefit. So if you add the two together, their $200,000 annuity with the $400,000 benefit from the AnnuiCare rider, they have now leveraged a $200,000 deposit into a $600,000 benefit. Now keep in mind, they own this money. They still have complete control of that $200,000. Now this benefit of $600,000 will be paid out over a 6-year period, so you just take the $600,000, divide it by the 6-year benefit period, and that's how we determine that's $100,000 a year, tax-free for 6 years, to pay for their long-term care expenses. Now here's something I want to point out. When they go on claim, they're going to spend their annuity first, penalty-free. And please don't see that as a negative, because remember, we're dealing with people that are currently already self-insured. For the next 4 years, they're going to get the same benefit paid out of the AnnuiCare rider, the two together giving them a total of 6 years of benefit. So essentially, they're still self-insuring here for the first 2 years, but for the next 4 years, they're covered. Now, what does AnnuiCare pay for? And again, this is just some of the nuts and bolts. And those of you that have any long-term care experience in your background, this will all be very familiar to you. AnnuiCare is going to pay 100% of the daily maximum benefit for home health care, homemaker services, hospice services, maintenance or personal care, respite care, assisted living, facility care, Alzheimer's care, and of course the nursing home. It will even pay up to 50% of the daily maximum benefit for adult daycare. So getting back to the question, what does AnnuiCare pay for? Everything under the umbrella of long-term care is covered. The next question may be, what has to happen before you can go on claim? In other words, how do we access the benefits? And you'll see that there's 2 triggers, and again, those of you with long-term care experience, these are going to be identical to the ones you're accustomed to. Trigger number 1 is being unable to perform at least 2 of the 6 activities of daily living. Now, that includes bathing, eating, continence, toileting, dressing, or transferring. Any combination of those 2, they can go on benefit. The second trigger at the bottom is cognitive impairment requiring substantial supervision, which is also quite a mouthful, but simply just means for cognitive reasons they're unable to adequately function on their own for a reasonable period of time. That alone would qualify them for benefits. So now let's jump into underwriting. Now I know you're all interested, how do we underwrite this product? Well, first of all, it is underwritten. They have to be in a reasonable health to qualify. But I think it's our underwriting style that you're going to like. It's simply an interview. Now, if they're 69 or younger, it's a telephone interview by a registered nurse. If they're 70 or over, that same interview is conducted face-to-face. And incidentally, we use the services of the Long-Term Care Group, and they are the largest third-party underwriter of long-term care in the country. And they've got a network of registered nurses. They can get out to the Badlands of North Dakota, wherever it needs to be done. So that is the entire process, the telephone or face-to-face interview. I think what you're going to like most about our underwriting is what we do not do. There is not going to be any medical exam. There'll be no lab work ordered, no attending physician statements, no medical records ordered. All of the things that slow down the underwriting process of an underwritten product, we have eliminated all of those and replaced it with either the telephone or face-to-face interview. Also, there's no substandard rating, so they either qualify or they don't. And because of this very unique underwriting style, you can expect a very quick response. Typically, it's going to be within 3 business days after the telephone or face-to-face interview, we will give you an underwriting decision. Incidentally, we are declining less than 20%. And I think that compared to traditional long-term care declines, our declination rate is just about half the industry standard. Now we're going to jump into AnnuiCare's premium limits. And when I say premium, I guess I should say annuity deposit minimum. For non-qualified deposits, the minimum is $36,500. Now that's going to generate roughly a $50 a day room. And you may be thinking, well, where can you go to the nursing home for $50 a day? Well, obviously you can't. But there's a lot of people that bought traditional long-term care many years ago, and maybe they bought a $100 a day room or $115 or $120, whatever, and they realized that's not enough to pay the bills today. They would like to have more coverage, but they're either unwilling or in some cases unable to pay additional out-of-pocket premium. So they can just go find some lazy money or underperforming assets like CDs, money market accounts, or maybe an asset at risk in the market, transfer that into the AnnuiCare annuity, get the additional benefit that they need, and it will pay right on top of their traditional long-term care. Now, for qualified deposits, and AnnuiCare can accept qualified money, this is extremely important. And the reason I say that is because it's estimated that approximately 80% of the investable assets in this country are in IRAs, 401ks, 403bs, TSPs, and the like. So the ability to put qualified money into AnnuiCare is very important. The minimum annuity deposit for a qualified account is $50,000. Now, I need to explain how this works. It will not remain qualified. You can't do that. But what we've managed to do is spread the tax on that deposit out over a 5-year period. So, for example, if they deposited $100,000 of their IRA into AnnuiCare today, they're going to get this year a 1099 for 20% or $20,000. The following year, they're going to get a 1099 for another $20,000 and so on until the end of 5 years. All of this is now non-qualified money. So what we've really accomplished is we've managed to spread that tax burden out over a 5-year period and hopefully keep them in a tax bracket in which they are comfortable. Well, I don't know if there's such a thing as a comfortable tax bracket, but at least one that they can live with. Maximum deposit for AnnuiCare, $300,000 per insured. And folks, that's going to generate $900,000 over a 6-year period of tax-free long-term care benefit. And folks, that's a lot of benefit. As a matter of fact, if they wanted to receive their care, let's say at the Ritz-Carlton in West Palm Beach, Florida, Ocean View room, that may be enough benefit to cover that bill. So let's move on. What we've done is we've just finished kind of going through the nuts and bolts, but now I want to talk to you about the opportunity and also the AnnuiCare advantages. Now, the first thing I want to mention about AnnuiCare is it's Pension Protection Act compliant. And the Pension Protection Act is over 900 pages of legislation, probably one of the most talked about pieces of legislation in recent history. Under the Pension Protection Act, AnnuiCare earns tax-deferred interest. The premium, the amount of money of the interest that's being used to pay for the rider, is now tax-free, and it also generates tax-free long-term care benefits. So being Pension Protection Act compliance, very important from a tax perspective. And I think if you look at AnnuiCare from an income tax perspective, it really provides the perfect tax combination. We've got tax-deferred and tax-free again. Now, those of you that have listened to company representatives speak in the past, I know we all have this character flaw, and we all say the same thing. Our company is the best, our product's the best, and here's why. And I'm no different, but I'm going to say it a little bit differently. AnnuiCare eliminates the competition. But what I'm going to do in the next minute or two is I'm going to prove it to you. So let's start out with experience. Because we were the first in the private or in the independent distribution channel to offer annuity-based long-term care, we have 15 years of underwriting experience. We have 15 years of high issue rates. We also have 15 years of policy owner and producer satisfaction. But most importantly, we have 15 years with no long-term care premium increase. Now imagine 15 years without any premium increase in long-term care. So what we are selling the rider for today on the annuity is exactly the same price it was back in 1999 when we first introduced this product. The end result is this. AnnuiCare offers the best rates in the industry, and also it has rate stability. Another advantage is no long waiting period. You know, we've seen some companies come and go in the annuity long-term care, or we call it the combo space. And some of these companies, and some are still there, they have this one flaw in their product. It's called a waiting period, some as long as 2 years. Let me tell you what that means. Let's say your client buys a product with a 2-year waiting period today. They get sick or injured tomorrow and they need care immediately. They have to wait the balance of that 2-year waiting period before they can even file a claim. And then after that, there's also going to be a 90-day elimination period. AnnuiCare has no waiting period, only the 90-day elimination period. So same scenario, they buy AnnuiCare today, they get sick or injured tomorrow. They can file a claim immediately and begin to receive benefits right after the 90-day elimination period has expired. So long waiting periods is a big edge. Now, what I'm going to do right now may be a little unorthodox, but let me tell you why I'm going to do it and what I'm going to do. There are 4 companies that sell annuity-based long-term care. It's Guaranty Income on the left, State Life next to that, Forethought, and over in the far right, Lincoln Financial. And what I'm going to do is I'm going to compare these 2 companies. And let me tell you the reason, or 4 companies rather. Let me tell you the reason I'm going to do this. I want you to be 100% confident that when you recommend AnnuiCare to your client, you are recommending it because it is clearly best in class. So we're going to compare it in 2 areas. The first area in the top, we're going to compare how much long-term care benefit, both illustrated at current rates and at guaranteed rates, do you get per dollar of annuity premium deposited. And down at the bottom, we're going to look at the future cash values based on current rates, because this is also important, because if these folks pass away and don't use the benefit, this is what will get passed on to the heirs. So let's start at the top. This is a male 65 depositing $100,000 premium. At the end of the first year, the total long-term care benefit with Guaranty Income, $306,000. The lowest of the 4 is State Life at $252,000, and then Forethought and Lincoln fall in between. Now let's push it out 10 years. Now our client's age 75. The AnnuiCare long-term care benefit will have grown to $367,000. Now the reason it's growing is because as the annuity value grows, the long-term care benefit grows right along with it. Of the 4, State Life will be the lowest at $276,000. So that's a $90,000 difference there. And then Forethought and Lincoln fall somewhere in between. Now, if you go out 20 years, age 85, and folks, this is kind of a sweet spot. This is where we'll see most of the claims. Excuse me, the AnnuiCare total long-term care benefit will have grown to $449,000. State Life, again, the lowest at $304,000, and then Forethought and Lincoln Financial fall in between. So from the standpoint for the $100,000 premium, how much long-term care benefit do you get? AnnuiCare is clearly best in class. Now let's drop down to the surrender value, and we'll look at that 10 years out and 20 years out. This is important for 2 reasons. One, sometimes people just run out of money. AnnuiCare may have seemed like a good idea, but you know, when the pantry is empty, in comes everything. So some of the people may change their mind and say, hey, I need this money for income. Others may pass away without using benefits, and this now is the money that gets passed on to the heirs. So at current rates, this $100,000 deposit, 10 years later, at our current rate, after the AnnuiCare premium's been taken out, will have grown to $121,000. State Life as lowest of the 4 at $104,000. Forethought, Lincoln fall in between. Now let's go out 20 years. The cash value of the annuity value of the Guaranty Income product will have grown to $149,000. Again, State Life the lowest at $109,000. Forethought and Lincoln fall in between. Now there's only one other thing to look at in comparing these products, and that's what does the rider cost? Now this is for a 65-year-old male. Guaranty Income is charging 95 basis points. State Life is charging 95 basis points. Forethought, very proud of their rider at 1.5%. And over here's Lincoln at 50 basis points. And you have to wonder, well, why is Lincoln so much less? Well, there's a couple of reasons. Number one, Lincoln has a one-year waiting period, so no claims can be filed during the first year. Also, any claims filed during the first 5 years will be paid at a reduced benefit. And here's the big one. It only pays the full daily benefit for the nursing home. Home health care, Alzheimer's care, everything else is paid at 50%, which kind of forces people to go to the nursing home to get their full benefit. So AnnuiCare, we pay full daily benefit for home health care, and we consider that stay out of the nursing home insurance. If you can get your full benefit and have your health care needs catered right into your home, that's probably a more attractive approach. So I want to point out, and this is really important, I believe AnnuiCare gives your clients the choice of dignity, and it's because we pay the full daily benefit for home health care. And it allows them to stay in an environment they're comfortable with. They don't have to meet their new roommate for the rest of their lives, and I'm not trying to be facetious, that's really how it works. And they can have their health care needs catered right into their home. Now, this is the most important thing I'm going to talk about in terms of an AnnuiCare Advantage, and this is the 1035 exchange opportunity. This is sales concept number 3. You know, a few months ago, I was out in Colorado Springs, and I attended a meeting put on by the Society of Actuaries, and it's called the Intercompany Long-Term Care Conference. And one of the Milliman actuaries, I don't know if you know who Milliman is, but biggest actuary firm in the country, pointed out that LIMRA has estimated that there's $1.86 trillion in non-qualified annuities in America. He made a second observation. For the first time in the history of annuity sales, this money is not moving. It's not in motion. It's collecting dust. It's staying right where it is. And they believe the reason why, and I believe it as well, is because these older policies that are out of the surrender period, back when interest rates were higher, they got a lifetime guarantee of 3%. Well, the newer policies they could buy today, or newer annuities, have guarantees of 1, maybe 1.5%. So why, if I owned an annuity that was guaranteeing me 3% for life, and I had no surrender period or surrender charges, why would I trade that in for one that guarantees me 1 or 1.5% and get a new surrender period? That's one issue. The second issue is insurance companies don't want that money because they consider that transaction to be unsuitable. I'm going to show you how to put this money back in motion via 1035. And what we're going to do is I'm going to show you how to beat the tax on a tax-deferred annuity. You know, annuities are tax-deferred. At some point, the tax on the gain has to be paid. We're going to beat that and solve their long-term care needs at the same time. So here's how it works. We're going to turn taxable annuity gains into tax-free long-term care benefits. So here's a simple scenario. You probably have clients or prospects in this position right now. Let's say they have an annuity right now. It's $100,000. Might have been in 3 or 4 annuities over the years, but right now it's $100,000. Their initial deposit or their cost basis in that annuity was $50,000. That means they have a $50,000 taxable gain. So again, annuities are tax deferred, not tax free. So at some point, the tax on that gain is going to have to be paid. At death, the beneficiaries will have to pay it right away. If the annuitant decides to withdraw money from the annuity, it's going to come out gain first and all taxable until all that taxable gain or tax is paid on that gain. Now, remember, there's a 9 out of 10 chance that this person doesn't have any form of long-term care insurance. So here's the maneuver. You 1035 exchange that $100,000 into AnnuiCare, so that now becomes a $100,000 AnnuiCare deposit. Now, Guaranty Income does not consider this to be unsuitable, and the reason is that AnnuiCare deposit of $100,000 will immediately leverage a $300,000 tax-free long-term care benefit. Now, here's how we beat the tax on the gain. Roughly 70% of people, and this is according to Genworth's study, are going to incur claims. Now, remember I told you with AnnuiCare, when they go on claim, it comes out of the annuity first. Well, guess what? It's the interest that comes out first, and it comes out tax-free. So for those who go on claim, that 70%, all of that interest is going to be pulled out, or at least a portion of it is going to be pulled out and paid in the form of a tax-free long-term care benefit. So what happens to the tax on that taxable gain? This maneuver has completely eliminated it. Folks, if you know people that have some of these older annuities, and they're happy because they've got their 3% guarantee, well, you might point this out or ask them this question: how long at 3% is it going to take 100,000 to turn into 300,000? Probably well beyond your life expectancy. So, folks, this solves their long-term care problem and eliminates a taxable gain on their annuity as well. So let's move on. Excuse me. On the left, you're looking at the AnnuiCare brochure. And you can get these from American Independent Marketing. The brochure it's a 4-pager. It's a walkthrough, goes from concept right into the close. It's even got a Q&A on the back. And also, very important, you want to get your hands on the AnnuiCare Marketing Guide. This is going to tell you the risks that we will take and the risks we won't take. Some of the automatic decline medications, for example, medications for memory loss or Alzheimer's type medications, that sort of thing. It's all listed in there. It's going to be a really good guide. So if you add all this together, when you look at these type of products, annuity-based long-term care, there's really 3 considerations. One is the price. What does that rider cost? Another one, how much long-term care benefit do you get for the dollar of annuity invested? And the third is, what are the future cash values that could be paid to the heirs, or at some day, if long-term care is not needed, converted into income? And folks, I think you'll agree on all 3 of these very important issues. AnnuiCare hits the bullseye. So folks, I'm going to turn it back over to David Whalen. I want to thank all of you for listening today. Incidentally, this was recorded, and appreciate you being on today. David?
Thanks very much. What I'm doing right now is I'm going to go through and I'm going to unmute everybody. I know that there are a couple of people that posed questions along the way. I would ask, though, if you do have us on a speakerphone for this presentation, please turn that speakerphone off so we don't get any unnecessary feedback. Bill Schuler, I know you had a question of David. Do you want to bring that up now?
Yeah, I just wondered, do you have any direct mail pieces that we can have access to, or any companies that you know of that have developed a direct mail piece for this product?
Well, the best answer to that is most of the states, although Medicaid and Medi-Cal are going broke, the departments of insurance make it almost impossible to advertise a specific product. So if you were to mention AnnuiCare or Guaranty Income Life, you're going to wind up with a very small ad and a whole lot of disclaimers. So my recommendation is you literally can advertise anything you want as long as you keep it generic. So to answer your question, no, we haven't developed anything.
Okay.
Craig Ombacher, you had a question as well.
Yeah, how is the proposed fiduciary rule going to impact qualified annuity if it passes?
Well, you're talking about how will that impact AnnuiCare with qualified deposit?
Yeah, with a qualified deposit, how is that going to impact? But basically, how is it going to affect our commissions? How is it going to affect how you're going to get it in front of the client?
Well, first of all, I don't think I mentioned commissions. Just so everybody knows, I'm glad you brought that up. AnnuiCare 10 through age 74 pays a 7.5% commission. I'm not an expert on the proposed fiduciary rule by the Department of Labor. I think acting in the client's best interest is always the best thing to do. We don't see anything on the horizon that's going to affect our distribution system or is going to affect our commission. That being said, I doubt if the fiduciary rule is going to pass this time around. There's just too much opposition to it, so hopefully we won't see that.
Well, one thing that I would like to say is with qualified plans, even IRAs, they are going to, if the fiduciary rule passes, we will not be able to take commissions on them at all. It will be fee-based planning only.
Yeah, I'm not, like I said, I'm not an expert on the proposed fiduciary rule, and my suspicion is if it does get passed, there's going to be a whole lot of changes and amendments to it, so it's hard to predict.
Thanks for those questions, Bill and Craig. Are there any other questions of David at this time?
What were the issue ages?
Oh, the maximum issue age for AnnuiCare 10 is 79, and the AnnuiCare 7 maximum issue age is 85.
Thank you.
Yeah, you're welcome. Thank you for your question.
You know, David, this is Dave. I have a question for you as well. As far as the underwriting, the way I understand it is that the health questions that are answered on the application are rather brief, but that the actual interview with the nurse, either be over the phone or in person, gets really in depth into the questions more about morbidity underwriting than mortality underwriting. Am I correct?
Yeah, absolutely. You know, and David, that's one of the reasons why we chose the annuity chassis as opposed to the life chassis. Although we may develop one on a life chassis in the future, but we made that decision because on the life chassis we would have to underwrite both mortality and morbidity. On the annuity chassis we only have to underwrite morbidity. But essentially on that telephone interview or face-to-face interview, they're going to find out what medications they're taking, what conditions they're taking them for. They're going to give them a brief cognitive impairment test. They'll have a word memory recall test. And that's pretty much it. The entire interview lasts about 40 minutes.
Okay, thank you.
You bet.
Had another quick question that was posed to me offline here. Company ratings. You know, I know that currently you have a B+ rating, correct?
Yeah, as a matter of fact, we were just elevated from B to B+.
Okay.
And would you like me to address the rating issue?
Yes, sure.
Okay. Guaranty Income has been around since 1926. So, you know, we've been there for a long time. We're a very stable company. About 7, 8 years ago, maybe it was 9 years ago, AM Best came out with a new rating system for medium to small companies. It's called the B-CAR system, CAR standing for Capital Adequacy Ratios. And essentially, the smaller companies like we are, medium to small-sized companies, have to have almost 2 times the capital adequacy ratio to get the same rating as a large company like Metropolitan, Prudential, et cetera. So a lot of it's just that the smaller companies' feet get held a little too closer to the fire. Now, on that B-CAR system, we currently would be an A- company. And we informed AM Best about that last year. And I think their intention is to baby step us up to the A category. So hopefully we'll go from B+ to B++ this year. And next year, who knows, we could be in that A- category.
Thanks very much, David. Another question came up, the surrender. I'm guessing the surrender periods. Obviously, the AnnuiCare 10 is a 10-year surrender, and I assume that the AnnuiCare 7 is a 7-year surrender.
Correct.
Did that answer your question, Kimberly?
It actually, on the AnnuiCare 10, it starts out at a 9% surrender penalty year 1, and then it decreases linearly to 0. So 98765432110.
Okay. Kimberly, sorry, I still had you muted. Did that adequately answer your question?
Yes.
Okay, good. Any other questions of David? Okay, with that, I will like to thank you, David, for doing this once again for us. We did record this session, so it will be saved for posterity purposes up on our website. Just a couple of upcoming webinars we're doing later on in July. Mutual of Omaha, with their traditional long-term care policy, just recently introduced their own electronic app, and I'll be doing a webinar in training on that e-app coming up on the 24th of July, which is basically, it's a Friday at 9 o'clock. And then we'll be following that up the following week with another session on teaching you how to sell remotely, so you can take advantage of selling across the internet and using the e-app to facilitate that. So thanks again, everybody, for taking the time to join us. David, as always, a wonderful job.
Pleasure.
And we'll look forward to seeing you again soon.